Hello there, my name is Tom Selby. I'm a senior analyst at AJ Bell. You will notice it's only my voice on this webinar today. I'm sure, as you can imagine, things are quite tricky getting everybody in the same room to talk about things at the moment with coronavirus. So I will be delivering these slides solo and in a recorded format as well, but hopefully will be useful to you post budget. So just a quick thought on where we are at the moment. So it seems slightly incredible that only 8 days ago, as I'm speaking, Rishi Sunak stood up and delivered with a reasonable amount of confidence, I would say, his first budget as the Chancellor of the Exchequer. I think it's fair to say that in my lifetime, I've never seen a fiscal event become quite so irrelevant, quite so quickly. He talked about a £30 billion coronavirus package during that event. We have since seen the government unveil a huge £330 billion government-backed loan package, along with cash grants for small businesses and extra business rate relief for the leisure industries in particular. So advisors will have heard this many times, I suspect, throughout their careers, but it does feel like we are living in unprecedented times at the moment, with unprecedented uncertainty for customers and for advisors, clients. Nonetheless, despite the coronavirus outbreak and the uncertainty that is surrounding that, the budget 2020 remains relevant. It seems strange to even be considering the relevance of a budget that was just over a week ago, but what was said in that budget remains relevant and has potential implications for clients and the way that they're going to be saving money in the coming tax year. So in that spirit, I'm just going to spend a bit of time today talking through the main things that were announced on the 11th of March and how they might affect clients. What was hidden in the small print? There's always something, of course, in the small print, and this budget was no exception. And then also just pick up on a few bits that have been left open potentially to future interventions from the government. So to kick off the big announcement, and the big announcement that we were expecting from the government was around the annual allowance taper. So just a quick recap on how the taper works, and I'll give you a bit of context as to the issues it's caused for the National Health Service. So introduced way back in 2016, the aim of the annual allowance taper was ostensibly to reduce the pensions tax relief available to the very highest earners in the UK. Unfortunately, the government at the time decided to do this in the most complicated way possible, and in a way that had consequences for various different people and various different clients in various different ways, and we'll get onto that. So two income measures that need to be breached in order for the taper to apply. So firstly, threshold income. So as you can see there on the slide, that's UK earnings minus any personal pension contributions, plus any salary sacrifice arrangements set up after the 8th of July 2015, plus any taxed lump sum death benefits received. So that's the first income measure. You've then got an adjusted income measure, which is UK earnings plus employer pension contributions, plus any tax lump sum death benefits received. Now, for the 2019-20 tax year, so that's the tax year we're in at the moment, where threshold income, so the first measure, is over 110 grand, and adjusted income is over 150 grand, the annual allowance taper kicks in, and anyone caught by the taper, this is the 2019-20 version of the taper, has their annual allowance reduced by £1 for every £2 of adjusted income to a minimum of £10,000. So that's how the annual allowance taper works at the moment. Carry forward still available when where someone has triggered the taper, so the ability to bring forward up to 3 years of previously unused allowances, but only up to the level of the tapered amount. Click through this next slide. So as I mentioned when I kicked off, the annual allowance taper has had various negative consequences for various different people in the country. And when it comes to the NHS, the tapers created something of a slow motion car crash. I think anybody, certainly you didn't need to be a rocket scientist or a brain surgeon in this case to see that there were going to be lots of people earning significant sums of money and building up quite generous benefits in the public sector. Plenty of those people will be senior doctors who tend to have unpredictable hours and therefore unpredictable earnings. And so if you go back to the previous slide there, knowing whether the taper is going to affect you depends on what your earnings are going to be, as well as what your personal and employer contributions are going to be. And if you're taking on extra hours and you don't know what earnings you're going to have, then you can't calculate what it's very difficult to calculate what your annual allowance for that tax year is going to be. Throw into that the fact that doctors are having to make quite complicated calculations, a lot of them without the help of an advisor, to work out the DB benefits they're accruing each year, and you get the headlines that you can see on the slide here. So why UK pension rules are fueling NHS staffing crisis, pension tax rouse risk absolute crisis with 1 in 10 NHS doctors quitting, and if we just add to that the problems created by coronavirus. So in terms of the political context here, so as we built up to the last general election, we'd seen multiple headlines like the ones on the left of the slide here, suggesting that the NHS was facing a huge crisis, and that crisis was being fueled in part at least by the UK's complex tax rules, and in particular the annual allowance taper. So the government already under pressure going into election and with an ageing population to do something to ease the strain on the NHS and to stop doctors turning down extra shifts that they need to take on in order to deal with the capacity issues. We then have an outbreak of a pandemic, which comes post-election, which means that this situation was even more pressing than it was before the election. So in the Conservative manifesto, they promised to deal with the NHS pension tax crisis, and on the 11th of March, with the coronavirus outbreak just kicking off and looming in the background, we saw the shape of the government's initial remedy to this. Now, what does the remedy look like? So we'll have a quick look at that on this slide here. So as I mentioned, Rishi Sunak announced changes to both the threshold and adjusted income measures. This will kick in from the 2020-21 tax year. So there have been lots of calls, including from AJ Bell and others, for the government just to do away with the annual allowance taper altogether, in a way that something that will both benefit doctors and simplify the pension system radically. Unfortunately, the Treasury seems wedded to the idea of having a taper in place, but it has at least announced some quite significant increases to the two different thresholds. So if we go on to bullet point 2 there, you can see threshold income rising by £90,000 from £110,000 to £200,000 from the 6th of April next year, so 6th of April this year, and adjusted income increasing from £150,000 to £240,000. Now, if you're thinking, where's the catch? Here it is in the third mini bullet point down there. The floor of the tapered annual allowance will decrease. So previously, the lowest point that the taper could hit was £10,000. This means that the annual allowance taper can continue taking effect and will continue reducing people's annual allowance all the way down to £4,000. So lots of people will be positively affected by this, but anybody who has adjusted income of over £300,000 will see their tapered annual allowance reduced to below £10,000, and anyone with adjusted income of £312,000 or more will be subject to a lower tapered annual allowance of £4,000. As with these things, usually probably easiest to work through an example. So we've got a couple of examples here, actually. So first one, Colin, an insurance company director who earns £150,000 a year. He pays in, him and his employer pay in the maximum, or what the maximum possible contribution that anyone could pay in with respect to the standard annual allowance of £40,000. So that's split £20,000 in her personal contribution and £20,000 in an employer contribution. So let's just compare what the annual allowance charge will be in the 2019-20 tax year with the current thresholds and the 2020-21 tax year. So looking at 2019-20, you can see threshold income is above £110,000. So remember, threshold income in this case would be his taxable earnings minus his personal contribution. So that's £130,000. So he's breached the £110,000 threshold income measure. Adjusted income is also greater than £150,000 here. So in this case, it's £170,000. So the earnings plus his employer contribution. So that means his tapered annual allowance, so he loses £1 for every £2 of adjusted income, is reduced to £30,000. And as a result, he is subject to an annual allowance charge of £4,000, so 40% on that £10,000 excess. If Colin had behaved in exactly the same way in 2020-21, when the new threshold income and new adjusted income measures are in place, his threshold income would be below £200,000, his adjusted income below £240,000. As a result, the taper would no longer apply. His full £40,000 pension contribution, comprising both employer and his personal contributions, would be within the standard annual allowance, and as a result, he would have no annual allowance tax charge to pay. So example 2, this is someone who would potentially be worse off under the new system. So Claire, a managing partner at a law firm, earns £290,000, receives an annual bonus worth £100,000, and she makes £20,000 of personal pension contributions to a workplace scheme, and so does her employer. So £40,000 in total contributions. So what does that mean for her annual allowance charge both in 2019 and 2020? Well, you can see in the bullet points there, in the current tax year, her threshold income is above £110,000 clearly, and her adjusted income is above £150,000, in fact, to the point where she has reached the tapered annual allowance floor of £10,000. So as a result, any excess will be subject to that annual allowance charge. As she's an additional rate taxpayer, the charge is 45% on the £30,000 excess over and above her £10,000 tapered annual allowance, giving us an annual allowance tax charge of £13,500. Now, if we roll into the 2021 tax year, and because Claire is such a high earner and enjoys such a significant bonus, her threshold income remains above the new higher £200,000 figure, and adjusted income is also above the new higher £240,000 figure as well. And not only that, but because her income is so high and is above, her adjusted income is above £312,000, she'll be subject to a tapered annual allowance of £4,000 compared to £10,000 under the previous regime. As a result, she'll be subject to a higher annual allowance tax charge of just over £16,200 on the excess. Now, two fairly simple examples there to show you how the taper could work and how it could affect clients both positively and negatively. The key action here is to reassess client pension contributions. So clearly some could benefit from an extra annual allowance depending on where their threshold and adjusted incomes lie, and those with adjusted incomes above £300,000 may need to consider alternatives to pensions or for the extra money that they would have paid into a pension, because their tapered annual allowance could be lower and as low as £4,000. So more tinkering from the government here, but in this case, I would say in the round for the majority of clients, this is going to be positive tinkering, and the key is to understand how it's going to affect them and to adjust their savings plans accordingly. So moving away from what was the big pensions change announced in the budget, another one which we were expecting and to come down the track to be confirmed here, and indeed was the rise in the lifetime allowance. So increase from current level of 1.055 million to the easily described level of 1.073100 or £1,073,100. I think the rounding team within the Treasury have clearly got a sense of humour and have got no intent on making that an easily memorable figure for either people like myself or for advisors and clients. So that's roughly in line with 1.7%, although there have been changes to the way that's been rounded year after year after year. You have to ask the Treasury as to why that is. In terms of the practical implications of that, clients who are affected just by the standard lifetime allowance, so clearly not people who have various different protections, will be able to save an extra £18,100 over their lifetimes in a pension in a tax incentivised manner, generating just over £4,500 extra in tax-free cash. So a small boost, but an expected boost there following the Treasury decision a few years back to link the lifetime allowance to CPI inflation. This was a weird one. The increase in the junior ISA limit. So the annual allowance has been increased significantly. There was no briefing of this. There were no stories about this before the budget. This was one that was picked up by our technical team as they were going through the documents, and it was left us scratching our heads, frankly. So from April, the junior ISA limit will more than double from £4,368 to £9,000, the largest increase since junior ISAs were introduced in 2011. One of the reasons this is so puzzling is the current average subscription to junior ISAs is just £994 per account, so way below the current annual allowance. It's hard to quite understand why the government has decided that the limit needs to be more than doubled at this stage, given those average subscriptions. Nonetheless, for a two-parent, two-child family can now put away £58,000 tax-free a year in ISAs when they combine their various allowances. So if you have clients with children, then the ability for those children to save in their children's accounts or their grandchildren's accounts tax-free will be increasing substantially from April next year. And in these difficult times, I think everyone should be taking advantage of all the tax allowances that are available to us, frankly, and that's another one that we'll have from the next tax year. So a few other minor tax tweaks. These aren't things to write home about necessarily, but things to be aware of as you're planning your client's finances. So the capital gains tax allowance has been increased. I think hiked is probably a bit strong here, increased by £300, so broadly in line with inflation. So not going to make a huge difference to anybody's lives, but every penny counts. So for basic rate taxpayers, that'll be £30 saved for non-property assets, £54 for property assets. Higher or additional rate taxpayers, £60 for non-property assets or £84 for property assets. And this was one that has been in train for a while. We've heard a lot about it in the election campaign. So a change in the national insurance threshold. So the point at which people start paying increases from £8,632 to £9,500. That change, like the others we mentioned, will kick in from the start of the 2020-21 tax year. A hugely political move, but one that will benefit the majority of workers, giving them an extra £100 in their pocket. Ultimately, the government has said for a while, and Boris Johnson said in his leadership campaign, he plans to raise the threshold to £12,500 in the future, although clearly the timetable of those kind of changes and other long-term ambitions may be affected by what's happening in the world at the moment with coronavirus. So some changes to housing policy as well, specifically stamp duty for overseas buyers. So overseas buyers are going to be charged an extra 2 percentage points in stamp duty. That's actually lower than the Conservatives had pledged in their manifesto when they suggested 3 percentage points would be a 3 percentage point charge on overseas buyers. That's going to kick in 2021, so not in 2020, not in 2020-21, but in 21-22. So not the coming tax year, but the one following. I think that's probably a clearer way to explain it. As a result of that year delay in bringing in the stamp duty increase for overseas buyers, the government's expecting a surge in activity in 2020-21 by people who are looking to avoid it. That will generate about £250 million in extra tax revenue. But over the longer term, the government actually expects it to cost it a bit of money before adding a little bit of money in the year after. So not clear how this will play out fiscally for the government, but clearly over the longer term, they're looking to discourage overseas buyers from investing in UK property and potentially freeing up space for UK-based buyers. This is an interesting one. So the NS&I funding target has been slashed. So this is one that was picked up by my colleague Laura Souter. So every year the national savings, the government sets the target for national savings and investments, how much money it's going to raise, and this has been cut significantly, so by about 40%, from just over 10.1 billion that was raised in the current tax year to 6 billion in the coming tax year. Now, doesn't take a genius to work out a lower target means that the NS&I has less need to attract new customers, and if NS&I has less need to attract new customers, then it's likely the rates that it offers will be much less attractive. You combine that with a base rate cut, and any customers who are in NS&I products or looking to invest in NS&I products are likely to get less back from their money than they might have previously thought they would. This is looking into things now that are buried in the details, and one that's been rumbling on for a while now is the UK Statistics Authorities and the Treasury's plans to replace the Retail Prices Index with the CPIH measure of inflation. So RPI has been widely criticised as an inflation measure for a long time, and so it's been no surprise that the government's face calls to scrap it in favour of a more accurate alternative at the earliest possible opportunity. The key question ahead of this budget, because we knew this review was coming, was the timetable over which the switch would take place and whether any transitional protections would be offered to people who were potentially negatively affected. The government's issued a call for evidence to see how people will be affected, but hasn't given any detail as yet as to what its plans are, and it's doing this very much in conjunction with the UK Statistics Authority. So we don't know yet at what point this change will come in, or the earliest point is likely to be 2025, and we also don't know what kind of transition measures will be in place to protect savers and investors. So why is this important? Well, replacing RPI with CPIH, if that happened overnight with no transitional measures, would have significant implications for savers, for investors, and for normal consumers as well. So, for example, DB schemes where scheme rules mandate members' retirement incomes rise in line with RPI. So if these contracts were ripped up and RPI was placed with CPIH, which tends to be just shy of 1 percentage point lower every year, it would effectively represent a stealth cut to people's pensions. Conversely, it would probably be good news, at least on one side of the equation, for DB schemes with RPI-linked increases baked into their scheme rules and could potentially reduce their deficits or their liabilities by billions of pounds. However, on the other side, for DB schemes and other investors, index-linked gilts at the moment tend to rise in line with RPI. If there was a blanket switch to CPIH, these would again be reduced in value significantly overnight. That wouldn't just affect clients who invest in index-linked gilts, it would also affect funds and pension funds as well that invest in those instruments. So there'll be, I suspect, as this call for evidence goes out, the government will receive representations from various people about the potential negative impact such a change could have, particularly to people who've already bought products, who've bought annuities linked to RPI, who are members of DB schemes with RPI baked in, who have index-linked gilts and have bought them on the assumption it was going to go up in line with RPI as we know it now. There'll be significant pressure on the government to make sure that those people don't end up losing out by what would look to most people like a retrospective change to the terms of their product. Now, this is an interesting one, and one which we're not entirely sure exactly how wide it could go. And again, it may depend to an extent on what happens with coronavirus and the current crisis, to the extent of the government's desire to deal with problems of this nature. But we've seen over 1 million people earning below the personal allowance, quite significantly over 1 million people, I think, now are being automatically enrolled into net pay pension schemes. And the problem here is that if you're earning less than the personal allowance, so in the current tax year less than £12,500, and you're in a scheme which is supposed to give you your tax relief automatically, i.e. one that takes it from your pre-tax pay, a net pay scheme as we say in the jargon, then you won't be getting a tax relief that you're entitled to. Now, some schemes operate net pay arrangements, have been making good the loss in tax relief that these people have been experiencing, but some schemes clearly haven't, and it's not an ideal position to be, both for the welfare of society, but also the optics of a government that's looking to do right by people who potentially have not traditionally voted for the Conservatives in the past. It's not a good look that people at the very lowest end of the tax spectrum are missing out on the tax relief that they are owed. So the Conservatives promised to look at this problem in their manifesto. The next stage of this is a call for evidence, but it's a call for evidence on pension tax administration potentially more broadly. Just a couple of lines in the budget, so we're not exactly sure how wide this could potentially go. But clearly they need to address the net pay issue. That will be the #1 priority. Other problems that we would like to see them address include the taxation of pension freedoms withdrawals. So at the moment, the first time somebody takes taxable income from their pension using the pension freedoms, they'll be placed on a month 1 tax code where that's a lump sum withdrawal. They'll have to wait until the end of the tax year in order to get their money back, unless they fill out one of 3 forms that the government has created. That's clearly not an ideal scenario to be in, where people are making withdrawals assuming they're going to be taxed at one rate and then are being significantly overtaxed as a result. And we hope this pension tax administration review looks not just at the net pay problem, but also at the problem of people being overtaxed and potentially being left struggling to make ends meet when they make their first pension freedoms withdrawal. But again, we'll have to wait and see the extent to which the government feels able to push ahead with some of these plans. In terms of what was missing, so as always, a lot of talk before the budget about various different ideas, a lot of kite flying, which in my view can be damaging to people's to investors, in particular to investors' confidence in the financial system and the way that already complicated rules operate. But nonetheless, we've had loads and loads of reviews about the inheritance tax system. We had rumours before the budget was announced on the 11th of March that business property relief was going to be scrapped. Those rumours, at least for now, appear to be unfounded. Various different reports and suggestions on the table from the Office for Tax Simplification, among others, looking at things like cutting all gifting allowances, reducing the IHT rate from 40% to 10% or 20%, or removing tax breaks for certain groups who it may be felt don't need those tax breaks. But at this stage, nothing to report on IHT, although we're likely to get at least one more major fiscal event this year, although what that fiscal event will contain obviously remains up in the air at this stage. So a watching brief on IHT rules, but I suspect given the the number of people who've called for reform and the fact that the Office for Tax Simplification, which is a just off government body, has suggested some quite radical reforms there as well, that this is something that will come back at a future date. What else was missing? Help for first-time buyers. So the manifesto made some quite significant promises to help people onto the housing ladder, but we saw nothing of note in the budget. Long-term mortgages for first-time buyers to cut deposit levels was one thing that we were expecting to hear about, but we've had no details on that and no mention whatsoever in the budget document. So if you've got clients who are potentially first-time buyers, or if you've got clients who've got children or grandchildren who are looking to get on the housing ladder, nothing really to help them with that beyond the existing product set of the Lifetime ISA and other Help to Buy schemes. But we'll have to wait and see as to whether or not the government feels able to bring forward help for those people. Given that it was in the manifesto, you'd expect to see something over the course of this Parliament. And what else was missing? Well, thankfully, from my point of view anyway, there were no radical cash grabs on pensions tax relief, and particularly higher rate pensions tax relief. So we saw the usual story, and in my nearly 11 years now covering this subject, I can barely remember a budget or a major fiscal statement that hasn't been preceded by suggestions that pensions tax relief is about to be reformed radically, that higher rate relief isn't about to be abolished in order for the government to raise tens of billions of pounds. Now, it always seemed unlikely we get it this time, given that we have a Conservative government in place whose voters would traditionally be people who are the 4 million or so people who are higher and additional rate taxpayers who would lose out significantly if higher rate relief was abolished altogether. But it's been our consistent view that the uncertainty and uncertainty ahead of budgets, the rumours and the speculation add to an environment where savers fear that there are going to be big changes to their pensions. It adjusts savers' behaviour. We'll see people piling money into pensions, which maybe is no bad thing, but equally you want savers and investors to be behaving rationally and making rational decisions based on their personal financial circumstances. So putting money into a pension because they fear something's going to happen that then doesn't happen based on some newspaper stories isn't an ideal situation to be in. Our position for a long time now has been to urge the government to simplify the system that we already have, but then combine that simplification with a commitment to stability over the long term, and to commit to keeping the pension tax rule broadly the same for at least a decade and potentially longer than that. So in terms of where our thinking is now on radical pension tax relief reform, so we would like the government to do away with the tapered annual allowance altogether. Despite the changes announced in this budget, it still makes it very difficult for people to plan, and it's a hugely complicated part of the tax system that has to be explained to clients of all different income levels, and to direct customers of all different income levels as well. The fact that we have a system at the moment where there are potentially 3 different categories of annual allowance, so a tapered annual allowance, a money purchase annual allowance, and the standard annual allowance seems entirely ridiculous to us. So we would remove the tapered annual allowance, remove the money purchase annual allowance as well, and we believe there's an argument for splitting the lifetime allowance and the annual allowance so that the defined contribution schemes are covered just by an annual allowance, and defined benefit schemes just by a lifetime allowance. Now that's an idea that we're floating around at the moment. It's something that the Office for Tax Simplification has floated as well, after something that we've spoken to them about. We'd be interested in your views into how that could be made to work, but we believe that the future of pension saving in the UK is defined contribution pension schemes, and if the future is defined contribution, then we should be doing everything we can to make that system as simple and easy to navigate for investors and their advisors as is humanly possible. So that's it from me. I apologise that it was just me and not Laura Suter, but hopefully you found some of the bits that we've gone through there useful. If you have any questions, clearly we're not able to do this live at the moment. I'm producing this from the AJ Bell bunker. So if you have any questions, then there is a question tab, I believe, on the right hand side. If you post your question in that tab, then either myself or one of the technical team will be able to get back to you. I've been informed that your CPD will be distributed shortly after this presentation, and that just leaves me to say thank you very much for listening to this webinar. Obviously a tricky time at the moment for advisors, for clients, and for all companies in the UK, but I don't think there's never a more important time to have a good financial advisor helping you through things than in difficult, turbulent times as we're experiencing today. So look after yourselves, look after your clients, and I look forward to hearing from you soon. Take care.